Well, yesterday was a very busy day. I happened to be part of participants at the first budget seminar held by the Securities and Exchange Commission, which looked at ways the capital market could contribute meaningfully to the growth and recovery process that the budget is intended to promote. The 7.30 trillion naira budget is tagged the budget of recovery and growth, and the capital market operators had a few things to say. So let's listen to excerpts from that particular seminar.
The federal government budget has proposed a budget of 7.29 trillion naira. This is one of the biggest and largest budget in the history of Nigeria. Large budget deficits could affect stock prices and undermine investors' confidence. We all know that the budget has almost 2.3 trillion naira to be funded through borrowing. The deficit is quite large. And the primary concerns for investors in the capital market in regard to both budget deficit and the public debt are the two related interests, which is the interest rates and the inflation rate. The end result of continuing deficit and increasing debt is most likely to result into severe devaluation, which we have all experienced in this country. Therefore, given the exchange rate and the stock prices, which we all know are closely related, currency depreciation will affect share prices in either direction depending on whether a firm is into exports or imports. And we have seen in the last 2 years, the stock prices have gone down.
When you have an expansionary budget, as we have this year, a lot more money, liquidity, will come into the system. As rightly said in the presentation, it will trigger inflationary pressures, and of course, there will be a need for monetary policy to also respond in terms of taking the monetary policy rate up. The relationship between the capital market and interest rates, especially the monetary policy rate, shows clearly that up on the 2007, both of them were going in different directions. But from 2007 till date, they started moving up together. Now, the explanation for that is this. Up on the 2007, what we had was no monetary policy rate, but the minimum discount rate, which was also administratively fixed without reference to developments in the domestic and the global market. So now when the regime of NPR was introduced by the central bank, they now began to take into account developments in the local market and also what was happening globally. You now find that that rate, NPR, began to respond to what was happening, and so it began now to also mimic what is happening in the capital market. And that talks to an important issue here, that our policymakers, and the presenter mentioned this, need to be more educated about the market, the vagaries of it, and what causes movement in market indices.
If you look at the budget of 7.3 trillion, you observe that the capital expenditure element of it is only 2.24 trillion. The budget deficit is 2.36 trillion. Funding is going to come from about 2.32 trillion. So in effect, the entire government revenue is going to be spent on debt service and recorded expenditure. So that means the investment into productive asset capital will be minimal. It's only contingent to the government taking from the public. So you find out that the 2.24 trillion, 1.254 trillion will be borrowed locally. And we're already seeing an economic environment where the private sector has been hemmed at one corner. We are being crowded out. So the government's ability to invest any kobo in infrastructure is depending on one, achieving the budgeted revenue. And we know, if you look at the presentation he made, where in 2016, the government failed to achieve the budgeted revenue projections. So if the budgeted revenue projection is not achieved, even the borrowing we see in 2017 will go into recorded expenditure. And unfortunately, the impact of recorded expenditure on economic development, on pulling the economy out of the recession is minimal because of the structure of our economy. So we have to look at the structure of the economy. Today, the country has very low productive capacity. So the recorded expenditure does not go into stimulating productive activities. And that is why we make reference to the recurrent expenditure going to stimulate consumption and import, because we do not have existing productive capacity.
When the minister says that 2019, before we will have local production, I mean, we're still in 2017. We're a country that needs triage, that needs immediate injection. We don't have time to wait till 2019. Otherwise, some of the SMEs or even the manufacturing companies that you see listed today on the stock exchange, they may not even be there anymore. I think the DG in his submission, he talked about the ASEM. A lot of the companies are small and they're not doing very well. What is hurting them? Power. You know, diesel has moved. So why are we so afraid of PMS movement? So why can the government, today NNPC is the largest importer. So NNPC can continue to find a way to import and the government subsidize that if they're so scared of just the price of PMS. But we have to do something. A lot of big companies use diesel. And diesel moved from 190 to 265 to 70, you know? And just think about that. How do you compete when you have to deal with all of that?
That's the million-dollar question. We'll be talking a little bit more about the power sector in just a bit. I'll be joined by Obianuju Nsofo. She's an investment analyst with AfriInvest. Join us again.